distributed energy resource portfolios. Oh, is the mic not on? Oh, it would be good to turn the mic on. Okay, cool. Great. So for this panel here, this is sort of unpacking the key questions that are relevant to all DERs beyond just solar. I think that there's a lot of talking points in the project finance landscape that conflate what's happening in solar versus the rest of the DER landscape. So we got three great panelists here to talk through some of the big questions in financing DER portfolios. I'll let them briefly introduce themselves and we'll go from there.
Well, Corey, thanks for having me. And it's great to do a conference in New York City back at home here, so it's
convenient.
Yeah, no kidding. My name's Nick Sangermano. I'm managing director with CohnReznick Capital. We're an advisory firm dedicated to the space. Renewables are what we would call sustainability overall. 30 people based in New York, San Fran, and a couple of other places, Baltimore and Chicago. Probably up to date now in the last 4 or 5 years, it probably raised upwards of 10 billion of capital, probably close to 12 or 14. And it's across a full capital stack, everything from venture money, very early stage, right through to late stage project M&A and asset sales and so on. So
great.
We're also affiliated, some of you may know CohnReznick, the accounting firm, fantastic group of people. They have about 100 people dedicated to the space as well. They're a sister firm of ours.
Awesome. Alta.
Good afternoon. My name is Alta. I head investment strategy at GE Energy Financial Services. There are two primary motives for GE Energy Financial Services. One, we invest capital on behalf of General Electric Company in the energy space, so we have about $13 billion invested. And the second objective for GE Energy Financial Services is really to help support the broader GE system. So as many of you probably know, GE offers products in CHP and renewables, in solar and storage. And so we look to try and help and better shape and form our understanding of the DER space.
Good afternoon. I'm Nick Whitcombe with the New York Green Bank. I lead their investments in portfolio management. We've heard a little bit about New York Green Bank today, but we're a $1 billion platform with the state of New York, and so far in the last 3 years we've deployed about $400 million, and as Richard Kaufman noted, that will prospectively be a much larger platform nationally with an additional $1 billion combined with private financing. We have, in New York, we've financed various DER type assets for consumer portfolios and larger portfolios. We continue to respond to the market and their needs, and the products typically we offer are senior secured debt, longer tenor than what commercial banks would seek to underwrite, and as well we try to underwrite and understand more difficult markets where contract structures aren't well understood.
Great. So maybe, Nick, starting off with you here.
Which Nick?
That's right. Sure. No, we can Nick 1, Nick 2. We can
exactly.
Mix and match.
I'll go, he's Nick number 1.
Nick number 1, 1A kind of thing?
Sure.
Anyway, so Nick, in general, how would you characterize the landscape for financing storage and all other more nascent DERs right now compared to solar, just sort of at a high level?
Great question. Financing for solar today has fallen along conventional project finance lines, where traditional project financing, where there's long-term financing against a utility type project, where there's an underlying investment grade cash flow. With solar, you've seen the same thing with residential solar, where there's medium-term bank notes or securitizations. Those are with investment grade because you have quite a bit of over-collateralization. They rely on large pools of customers and diversity, and those have all been rated by the rating agencies. The principle is that you can understand the technology and you can understand the underlying cash flow. Now, when you start to go to other DER type assets, which includes, say, batteries, the principal issue is what's the technology and what is the underlying cash flow. I will add also two other things that the market can understand with, say, solar securitizations, is there's large liquidity and that there's scale. And so once you achieve an understanding of the cash flow, the technology, reach scale, and then there's liquidity, meaning market participants like Nick Part 2 tries to arrange, you'll begin to have a much more vibrant market. Now, but also to answer your question in terms of, say, solar securitization, it's not a huge market. It's about $2 billion across PPA and leases and loans, and also PACE type financings. But it's developing, right? But it hasn't developed, say, to the size and scale as, say, auto finance has. So those markets will develop.
Right. Yeah, and I think you point to a couple, particular risks that are, not unique to all DRs besides solar. Solar has this issue too, but the technology risk in terms of how relatively more nascent it is compared to a somewhat more mature solar asset class, and also the cash flow risk. That was something, Alta, we were talking about earlier as one of the big, red flags when you're thinking about deploying capital for, say, a storage portfolio. In practice, what's been your experience about the particular risks underneath the cash flow performance of a storage portfolio compared to solar?
So and I'll just caveat that GE tends to look more at C&I cases as opposed to residential. So these comments are targeted more towards C&I. We certainly care about technology. We typically don't invest in brand new technology, but that being said, a lot of even though lithium-ion has been here for a while, in terms of thinking about how the application gets used, the charge, the discharge, how long is that going to last, the usage. If you think about from a project finance standpoint, 10 to 15 years, that's an awfully long time to be taking a risk as to the technology, the warranty, the guarantee, everything that wraps that particular product. It's also incumbent upon, as an investor, to really think about for 10 or 15 years what the revenue stream is going to look like, and whether or not there's going to be changes in policy or changes in reform that ultimately impact that particular revenue stream. So there's a lot of risks to think about, and I think that sometimes people underestimate how that then affects the certainty of the cash flows coming through.
Right. And so for storage specifically, and solar plus storage, this is relevant too. What is it specifically about, the nature of the cash flows? Is it specifically the fact that demand charge management as a revenue stream is a more unpredictable one, or are there other particular red flags that stand out within the cash flow that's backing these assets?
Well, I think it's about understanding the different value propositions or the different stacking of revenues and how they interact with each other. So I think that's one thing that makes storage somewhat unique. The other thing that we were talking about earlier is we did an assessment. We were trying to invest in a storage facility for ancillary services. And so we did a whole analysis that showed that for the first, let's call it, 12 storage projects deployed, there was actually benefit. But there was a tipping point where the 9th or the 10th or the 30th one kind of decreased the value of the ancillary services for the whole pot. And it was hard to determine how many of these projects were going to come online and at what time periods and how they were going to interact with each other. So there are a lot of other exogenous considerations that we have to think beyond just the particular project.
Gotcha. So what's the sort of ideal makeup of a storage project right now for you in terms of what would be the ideal revenue stream, customer mix? What is GE looking for right now in a storage project?
We're looking for projects that have revenue certainty, where we can really wrap our heads around the costs. We're also looking for potential scalability, because that's something that we talk about quite a bit. Each project that we look at right now is relatively bespoke, and that costs us human capital resources and opportunity costs to look at an individual project. We're willing to do that if we think there's going to be a pipeline following it in terms of bringing substantial volume to our business.
Gotcha. So Nick, how does that jive amongst other potential bidders that you're working with or trying to attract for deals that you guys are selling?
Yeah, I might go back to the first question that you gave
Sure.
to Nick, number one.
Go for it.
So great points. I would say from my perspective, if you're looking for capital and you're in this space and you're in the DG side, and DG is a specialty of ours, we love DG, it's a big focus area for us, C&I especially. It's never been a better time. It really hasn't to raise capital. It is you called it before, a seller's market.
Yeah.
And so if you're a good company that has a pipeline, it's a great time. Why is that? On one hand, you have challenges of any kind of emerging technology or business model, right, on the infrastructure side. So you've got challenges that you'd expect, not that sophisticated with investors yet. There's some technology shakeout still happening. There's some business model issues, the revenue sources you mentioned. Those are all factors, but on the other hand, mature solar DG is a stressful place to be an investor today. There's a lot of pressure. It's we like to use the analogy, unfortunately, because a lot of these investors are our friends and worked with them for a long time. It's a knife fight in a phone booth, right? And there's a lot of people. It's the Ricky Bobby, right? If you're not first, you're last. Like it's so many people are in these auctions.
There you go.
And they're sort of sweating bullets. And they're looking, hey, what else can I do? What can I do? We get calls like this constantly. Like, is there anything else? Is there any process at all that you can show us that we're not fighting against 10 or 12 or 15 other investors trying to kill for a project? And that's really opening the door, particularly in my mind, to storage. People are opening. In fact, we closed the deal today. An hour ago, we announced actually a $25 million commitment for a company called GLM Energy. My colleague, Mark Barnett from Foley Hoag, senior counsel in the deal, he's here today. And Mark and I were just talking, about 4 years ago, we closed our first solar DG deal. And how similar storage today is to where solar DG was 4 years ago. But the difference being how quickly we think it'll ramp up to be back to mature. Like that storage will get there a lot quicker than solar DG did because of the competitive pressure with capital. Just not that many projects, lots of capital.
Yeah, so what does that mean in practice, though? If it is a seller's market, are you seeing, what are the typical number of bidders that are trying to acquire storage portfolios that you're selling? Are you seeing pretty comparable, sponsor returns for storage now that's compressing relative to solar? Across those two fronts, what are you seeing?
I'll start with pricing first, probably.
Okay.
Why not there?
Sure.
There's a premium for sure for storage.
Okay.
There's a premium for a couple of reasons. It is new. There is some business and merchant risk often to these deals. There's some perceived regulatory risk. It's not as mature. It's not as shaken up. Some investors are a bit skittish, especially on the infrastructure side. GE is pretty innovative actually with STEM and other companies, right? So it has a lot more experience. But most investors, especially on the project side, are a little bit more shy. Sure. But I don't think you're getting overpaid. So I think it's a few hundred basis points depending on the deal. And I think that's probably fair compensation, right, in terms of pricing.
Okay. So a few hundred basis points relative to what would be like?
To like a typical distributed solar portfolio. Also, the scale is different, right? Okay. You're just not seeing the scale yet.
Okay.
So, for example, in our deal, there would have been that kind of spread between distributed solar probably, but the scale is just not large yet, and that's playing in as a factor as well. Okay. So, yeah. What was the first part of it?
And then the other part was just sort of the makeup of who's actually bidding on storage portfolios right now and just the volume compared to, say, solar.
I feel like almost any kind of project investor will take a call. They'll take a call or they'll respond, they'll sign an NDA. They just want to see what's there. They want to hear the story. They're being open-minded and flexible. Yeah. So you're seeing certainly mezz capital is all over it. You're seeing a lot of private equity, infrastructure private equity type of capital for the size that can play at that price point. We're not seeing hundreds and hundreds of millions of dollar deals, although Macquarie did one in CIT, right? So just earlier this year. But they're pretty rare still. But in terms of that, what I would call mid-cap infrastructure, you're seeing players there. We're also getting a lot of response from insurance companies, even the occasional pension. So, yeah.
I think our message out to you is that there's a lot of capital out there for well-structured companies, projects, and that there is a lot of capital looking to be put to work. And so it's really about coming up with the right value proposition. And keeping in mind that investors aren't going to just give away their money for free, and they're not willing to not get return
that's the big point.
Of capital.
That's the big point is don't be greedy.
Yeah.
If you're looking for capital, don't be greedy. There will be a competitive process, but people want good partners that they can deploy a lot of money with. Right?
And if you're looking at in terms of, say, a lender, and you mentioned insurance companies, these are long-term assets, right? And from that perspective, by nature, that suggests then that you're going to have a long-term debt in place, either with one lender or it matures and you have to refinance with somebody else. Because of the nature of the asset, in which it's, say, batteries in particular, lenders may require more equity, right? Lenders also may require a higher debt service coverage ratio, which then depresses equity returns, which then pushes it into a certain investor class, and it may be insurance companies who want that long-term asset with that who can accept that return profile.
Yeah, and I mean, the interesting thing here is, so you mentioned the example of the deal that was just announced, it's $25 million. I mean, I don't know, so from GE's perspective, I don't know whether that's, too small of a deal where, more strategic like you guys would be involved. And sort of, I mean, keeping that backdrop in mind, Nick, I'm curious, what role the Green Bank can play in sort of bridging the gap, for like the period of time right now where you're seeing maybe more sub 50 million, even sub $30 million deals, to getting to the point, at least for what we're seeing in solar, where a lot more public announcements for $100 to $250 million transactions.
They'll typically be smaller, more bespoke transactions. Mm-hmm. Ideally, we'll want them to be replicable. Ideally, we'll want them to have a pipeline in place. We'll be the party who will take a look at these deals. We'll invest the capital resources like you may not want to, and see if we can structure a financing package around them. So it's a unique role we'll play. If we see there's an opportunity, mm-hmm. and it may be smaller, we could be the ones who would step in and intermediate until that market develops.
Gotcha.
Or provide part of the financing structure that there may not be a capital provider willing to do. And so maybe we'll be partnering up with another financial institution who will take the shorter risk, and we'll take the longer risk. They'll take the shorter risk on a view of the cash flow profile. We may take the longer risk based on the value of the collateral because it's a long-term asset. So there's different ways to look at the risk in terms of how we ultimately get repaid.
Interesting. So, Alta, I didn't mean to speak for you about the $25 million example there, but is that level of scale, are you willing to go down that low for a deal size, or is that still kind of too small of a?
So I think that we face a challenge that many energy investors face, which is as you look at the broader landscape and how there used to be these larger, bigger infrastructure projects, like putting $150 million to work wasn't as big of a deal. Now as everything is evolving more to a distribution level, one of the struggles that we have is what's the right balance in terms of making sure that we get enough capital put to work, but at the same time, taking the time to really assess the risk return profile of each individual project. So we have gone down in size in terms of what we're willing to look at. And again, to just reiterate, with the expectations that somewhere along the way we do get an opportunity to scale up. Gotcha. But we've done projects as small as $1 to $3 million, as long as we know that there is a full pipeline behind it.
Yeah. Interestingly, what's happened here is, what we see anyways, is that deals, there's lots of talk of doing bigger deals, bigger scale deals, hundreds of millions of dollars potentially, right? And there was in our deal and others.
Yeah.
But companies primarily are hesitant because they don't want to lock in at a certain cost of capital. There's just a feeling that there's going to be progression here quickly, and more capital will deploy in, and there'll be that competitive dynamic, and cost of capital will actually drive down. The industry will mature quickly, and you sort of don't want to lock yourself in, right, for a number of years and sort of be beholden to a capital provider that may not be able to adjust their cost of capital over time. So what seems to be in vogue these days is sort of like, let's take this like one date at a time sort of thing, instead of let's get married for the next 5 years, right? And it's a bit more to kind of use that analogy.
Right, so no DR provider is interested in long-term commitments. They're just can't handle a relationship or any of that stuff, basically.
It's a one-night stand.
Yeah. All right, there you go.
But back
maybe we need to switch analogies. That's all right. Let's keep going.
But back to the $1 million deal.
Yeah.
We can do the $1 million deal at New York Green Bank. We'd rather do 25 $1 million deals in an aggregation facility where the asset's the same, the contract's the same, and then we can build up a portfolio. The idea is then it gets refinanced at some point, or maybe if a securitization market develops around those, say, chunkier assets. Mm-hmm. That's a little bit down the road in terms of investors who will buy those pools of chunky long-term assets, unlike residential solar, which are tens of thousands of customers. So that's something. It's an impediment to the securitization market developing. I think it was one of your questions that you wanted to address.
Yeah.
But you do have to have diversity. But you have to have commonality as well in terms of customer types and contracts and things like that.
So is that a structural issue to what we're seeing be deployed in the DER market outside of solar right now, especially when you think of like a lot of storage being pivoted a bit more towards C&I customers? So if you're trying to put together securitization for C&I storage, you have fewer customers compared to a resi solar portfolio. Like, is there something structural too about the rest of the DER market that may not be able to tap into, say, the ABS market? Or is it, are there other barriers that can be addressed to access some of those cheaper sources of financing, do you think?
Are there other barriers that can be addressed to access to cheaper sources of financing? I think it really comes down to the technologies, the cash, whether it's lead acid or lithium ion or flow batteries, whatever it comes down to, and that investors have underwritten those types of technologies in advance. They know what they are. They're in DNVGL's book, and they can just pull it out, right? And then it's a level of understanding of what the cash flows are. There might be lease-based cash flows. The tenant or the C&I customer may be paying for use of that, whether it's resiliency, right? Whether it's backup storage, whatever it may be that provides value to that customer. And most likely now it's not going to be, gee, I hope there's going to be ancillary services off of it. It can't be I hope. It has to be I have now.
Real.
Yeah.
No, that makes sense.
See, I would never, for me, I would never recommend people go like securitize a route or ABS or something like that. That might happen in a few years, but there's just plentiful private capital right now. And why put yourself through all that? Why bang your head against the wall and try to do that? We've been approached.
Is that true for solar? Would you recommend that as well?
I would, yeah, for sure. I mean, most of the deals we're doing lately are private transactions. We did a...
Is that just because of how cheap private debt is, though? And I mean, it's long-term, depending on your view on interest rate risk, right? That could change, or...
We have a lot of happy clients that have access to private capital markets. Probably our big landmark deal this year was S-Power, right? Where it's a $1.6 billion deal that we did in conjunction with Barclays and Marathon. So, it's there's a great example of a pension, major pension, the Inco pension out of Alberta, in tandem with a strategic, for example. But there's a lot of cases of this. So, I think, if you're on, anything other than solar DG, you're in the DG world other than solar, there's plenty of capital providers that would love to sort of go bilateral and come up with creative ways to work together.
Gotcha.
Yeah.
So this is a bit more of a niche question, but one that a few folks were asking about that I think you might have exposure to, and then if either of you have comments on it, be curious as well. But so specifically for solar plus storage projects in the multifamily sector, do you have any thoughts on whether we're seeing much traction yet in terms of financing portfolios along that front yet, or is that something you sort of see happening over the near term?
You mean more like a resi play?
Yeah, it's like a resi multifamily for solar plus storage in particular.
I talked to my colleagues about this actually before we had this, before we caught up earlier today, and the consensus is that solar storage together in resi or multifamily is something that's emerging that seems to be kind of a layup, particularly on the tax equity side and kind of the mechanics of it. People are good at it for those that are doing it. There hasn't just been a lot of volume yet, but it's something we see growing for sure. Yeah.
And the volume issue, I'm sure, I don't know if you've come across this too, but I guess it still goes back to the cash flow risk issue as well, in terms of whether the backer is, whether it's pegged to residential retail rates or commercial resale rates, which goes along with one of the other questions that we had on cash flow uncertainty was, specifically with respect to future utility tariff risks and changes on that front. How is that risk accounted for in deals that you've been looking at?
So One of the nuances about storage and solar storage is kind of interesting is some of these deals are pegged to what am I going to get for cost savings relative to what I'm paying the utility. And that sounds great, except for what happens if the utility decides to change its rate structure. Then what does that look like, and what kind of cost savings are you getting, and how ultimately how do we get paid? So we run a wide range of analyses as to try and determine, what could a utility do, how much could that rate change, and what it's really brought us down to is a very complicated tariff structure, which I never thought I would get into. But it becomes just much more pertinent, like the localization of these projects, which utility, which rate class are you in, and just really drilling down and understanding that, and really understanding what could possibly change going forward. And that's tough to quantify, and that's something that we talk about quite a bit. And from our perspective, there needs to be ample return for the risk that we're taking. We view that as a real risk. Some investors don't view that as a risk. And so I think you'll find different investors have different risk appetite for that particular one.
So pivoting away just from storage, and I work in government, and to reflect Cameron Bard, I can answer any question I want. So we've looked at tariff rate structures quite a bit at New York Green Bank, and we've for every utility, every zone, every service class. And that's particularly important relative to community solar, because the customer needs to get value. And the contract, ideally, is always priced under the tariff in general, right? And so the question then goes, gee, I can understand the supply charge, but the T&D charges. Now that gets a little bit harder because that is actually under rate base, more or less. And so forecasting that out for 20 years or so gets to be difficult.
Yeah.
Gets to be even more difficult when you have a counterparty who wants to do 3 and 5 year contracts with, say, residential or C&I customers. A little less difficult where you have an 20-year index contract. But you're still asking yourself, well, how am I replacing them? At what price am I replacing them? And so it becomes a challenge of just long-term price forecasting. And if you go back, and memories are long, to the early 2000s with all the merchant generators, the banks lost a lot of money with some names I won't mention, but there are quite a few of them. And so the memories are long with credit committees. Oh, now we're back again at price forecasting, not forecasting natural gas. Well, you still are pricing natural gas, but you're pricing also regulatory interventions too.
Yeah, there could be an entire panel on just community solar project finance in New York's value DER proceeding, which could be next year's panel for sure.
Next year.
But unfortunately, we're out of time here. They'll all be available for follow-up questions. But with that, let's give our panelists a round of applause.